The most profitable way to trade a trend is to treat it not as a straight line, but as a diagonal trading range where 75% of breakouts fail. Most traders draw a single line and call it a trend, but price rarely moves in a straight wire. To understand where institutional computers are buying and selling, you need to identify the upper and lower boundaries of the move. This structure is called a channel. Think of a channel as a diagonal trading range. Just like a horizontal range, traders buy low and sell high, but the whole structure is tilted up or down. Recognizing this tilt early allows you to enter with the trend while getting excellent risk-reward ratios. Let's start with drawing the lines correctly. In a bull channel, the most important line is the trend line, which connects the higher lows. You need at least 2 points to draw it, but a third touch confirms the line's validity. Once you have the trend line, create a parallel copy and drag it to the most significant high between your anchor points. This is the trend channel line. This line tells you where the trend is likely to pause or reverse. The angle and width of these lines determine your strategy. Institutional algorithms are programmed to take profits at the trend channel line and reload positions at the trend line. We simply follow their lead. We categorize channels into two types: micro channels and broad channels. This distinction is critical because they require completely different management strategies. Mistaking one for the other leads to early exits or trapped positions. In a micro channel, the trend is so strong that price bars have little to no overlap. This is essentially a breakout on a higher time frame. Do not fade this. You enter and hold until the first close below a prior bar's low. A broad channel is different. It effectively trades like a range. In a broad bull channel, you buy the test of the lower trend line, but you also take profits, or even short, at the upper trend channel line. The most common mistake traders make is chasing price when it accelerates. Often, price will burst through the trend channel line. This is called an overshoot. Novices think it's a breakout. Pros know it's a climax. An overshoot represents extreme exhaustion. The market has gone too far, too fast. When price reverses back into the channel after an overshoot, it usually targets the opposite side of the channel. This leads us to the 75% rule. About 75% of attempts to break out of a channel fail. If price breaks the top of a bull channel, look to sell the reversal. If it breaks the bottom, look for buyers to defend the trend. However, successful breakouts do happen. A successful breakout of a trend line signals a potential trend reversal. But be careful. The first break of a trend line is usually just a transition into a trading range, not an immediate crash. When a channel breaks cleanly, we use measured moves to calculate targets. The simplest method is to take the height of the channel and project it in the direction of the breakout. Let's visualize this. Here is a bear channel. We measure the vertical distance between the trend line and channel line. When price breaks above the trend line, we project that same distance upward to find our profit target. Another crucial pattern is the spike and channel. Markets often begin with a strong impulsive move, the spike, followed by a slower, broader movement, the channel. The channel is essentially a long, complex pullback. Eventually, the channel weakens. We look for a wedge shape, where the channel lines converge. A wedge typically has 3 distinct pushes. 3 pushes to a high in a rising wedge is a high probability reversal signal. When trading the wedge top, you aren't just guessing. You wait for a strong signal bar closing near its low. Your stop goes above the wedge high, and your target is the beginning of the wedge. Let's review the undershoot. If price approaches the trend channel line but fails to reach it before turning back, it shows momentum is fading. This undershoot often precedes a break of the main trend line. Context matters. A channel in a strong trend is a continuation pattern. A channel after a long trend is often a reversal pattern. Always look left. Are you in the early phase, spike, or the mature phase, wedge? If the channel lines are flat, you are in a horizontal trading range, not a trend. The rules change here. Buy low, sell high, scalp out quickly. Do not hope for breakouts in a horizontal range. Sometimes a channel evolves. A steep channel breaks, price corrects sideways, and then a broader, flatter channel forms. You must constantly redraw your lines to match the new market structure. Let's look at a complex example. Here, price breaks the bull trend line. Many sell immediately, but notice price didn't make a lower low. It formed a broad bull channel instead. This brings us to the concept of two legs. When a channel breaks, the market usually attempts to retest the extreme. Expect two legs of correction before the trend resumes or fully reverses. When drawing lines, use the candle wicks, highs/lows, not the bodies. The wicks represent the absolute extremes of price rejection, which is where the algorithmic orders are sitting. Trading channels requires patience. In a broad channel, you might wait 20 bars for price to get from the bottom line to the top. Do not exit early just because the market is slow. Trust the structure. Remember the mathematics of the channel. If the channel is broad, the probability of a reversal from the top is 60 to 70%. If the channel is micro, tight, the probability of continuation is 70%. Adjust your bet size accordingly. To summarize, draw your trend line on the lows, bull, or highs, bear. Create a parallel copy. Buy the bottom, sell the top in broad channels. Hold in micro channels. Fade the overshoots. Your homework. Open any chart, find 3 channels, and identify where the overshoots happened. You'll see exactly where the reversals began. Next, we will cover trading ranges in depth. Master the channel, and you master the trend.